Following the failure of the exchanges FTX and FTX.US, cryptocurrency values plunged. The repercussions keep coming. Major digital assets gave back their gains during the 2022 crypto crash after a spate of high-profile explosions. Before we continue, make sure to subscribe to us now. Exchanges FTX and FTX.US filed for Chapter 11 bankruptcy on November 11, 2022. The effects of the catastrophe are still being felt, and BlockFi declared bankruptcy on November 28. The cryptocurrencies Terra USD and Luna failed in May 2022, and other crypto sites folded as a result. Lower prices are also a result of rising interest rates. What then happens when virtual currencies like Bitcoin crash? It can be important to keep in mind a few recognized investing rules, such as deciding how much of your overall portfolio should be invested in cryptocurrency, even though the circumstances causing each coin meltdown are different. What might result in a crypto crash? Major cryptocurrency events, including the collapse of exchanges or coins, can have a significant impact on cryptocurrency prices. They can also lose value due to rising interest rates, inflation, and other macroeconomic issues that may reduce investors' levels of confidence when investing in risky alternative assets. Additionally, when prices drop sharply, as they did in 2022, it can increase market pressure by requiring some investors to release capital so they can fulfill their commitments. The market was significantly affected by the FTX disaster. Along with FTX, other companies FTX did business with and cryptocurrency FTX heavily invested in, including Solana, were also impacted by the crash. BlockFi, a cryptocurrency exchange that had a credit line from FTX.US and was slated to be bought by the company later in the year, stopped allowing withdrawals before declaring bankruptcy a few weeks after FTX.US did. Has cryptocurrency ever seen a crash? Indeed, numerous times. For instance, in December 2017, Bitcoin reached a prior record high of about $20,000, but by December 2018 it was only worth $3,500. In November 2021, it hit an all-time high of around $69,000. However, it has since decreased by more than 75%. Concerned about leaving my cryptocurrency on an exchange? What ought I to do? Think about transferring your digital assets to a different crypto wallet. Most exchanges let you move funds to these wallets, which can be either offline or online on a different platform, on a thumb drive with added security features. What dangers exist in purchasing cryptocurrency? Someone who has been interested in cryptocurrency from a distance may believe that a crash is the perfect opportunity to invest and buy low. Although prices can and have recovered in the past, the process may take several months or even years. It's also possible for things to grow worse before they get better. Prices may drop for some time after a significant fall, particularly if the incident results in financial difficulties for other exchanges or currencies. Crypto markets lack circuit breakers, which immediately halt trading when prices fall too sharply, as opposed to conventional financial exchanges. This indicates that prices could fall considerably more quickly than traditional investments. Additionally, after a significant sell-off, any specific cryptocurrency may drop to zero or very nearly zero. The same applied to Terra and Luna. Prices for cryptocurrencies may appear appealing when contrasted to the highs from which they plummeted while the market is down. You may even claim that they are on sale. Given that a price bounce isn't assured, some investors might be hesitant to buy the dip. Some people might be glad to remain idle. It is hard to predict how a particular cryptocurrency will behave in the months to come. However, employing true investment techniques can increase the probability of long-term success for your portfolio. Number 1. Average cost in dollars. This approach incorporates the adage that you can't timing the market in investing by prioritizing agnostic consistency over holding out on asset deployment until the right time. Dollar cost averaging entails committing to a pattern that doesn't take market conditions into account, such as purchasing $250 of Bitcoin on the first day of the month, as opposed to relying on luck to determine whether the market has reached its bottom. Whether the price is rising or falling, you make your purchases as planned. Maximizing short-term gains is not a smart use of this method. However, over time, this steady buying might mitigate the consequences of volatility, which is a notable feature of cryptocurrencies. If you set up a recurrent purchase, several of the best cryptocurrency exchanges can dollar-cost average for you. Number 2. Examine your investment mix. The mix of all your investments, including stocks, bonds, and real estate, is referred to as asset allocation. Another strategy to diversify is to own investments across a variety of asset classes. It's generally advised to only invest what you can afford to lose in hazardous assets like these because of how volatile cryptocurrencies are. As a general rule, allocate no more than 10% of your portfolio to them. Your customized goal allocation of stocks, bonds, and other assets can be changed to reflect your unique risk profile and time horizon. Generally speaking, it's a good idea to have a higher percentage of conservative assets if you need those funds quickly to prevent significant value changes, such as high-yield savings accounts or short-term bond funds. Number 3. Balance out your stock portfolio. Assume that you begin with a specific asset allocation, such as 75% in equities, 20% in bonds, and 5% in cryptocurrencies. As the value of your investments changes over time, those percentages will also vary. You'll need to rebalance your portfolio to get them back to your goal allocation. In order to rebalance a portfolio, you must sell assets that are overrepresented compared to your desired asset allocation and purchase assets that are underrepresented. Rebalancing would entail selling other components of your portfolio to raise your crypto holdings to your target allocation of 5%. For instance, if your crypto investment lost money and fell from 5% to 2% of your portfolio. Although some financial platforms offer automatic rebalancing, if your investments are dispersed throughout several accounts or institutions, you might need to perform a manual rebalancing. Number 4. Mix up your cryptocurrency. When cryptocurrency prices fell in 2022, many people lost money. However, if all of your money was put in Terra, Luna, which virtually lost all of its value, you were burned. It would be wise to diversify your holdings if you have a sizable investment in just one cryptocurrency in order to avoid suffering the same fate. Spreading your money among many investments is what is meant by diversification. It takes away the chance that a single investment will ruin your entire portfolio. A more diversified strategy than putting all of your money behind one coin is to purchase many cryptocurrencies that represent a variety of use cases. Number 5. Tax loss harvest. You might employ a tax approach known as tax loss harvesting to mitigate some of the harm if you have cryptocurrency holdings that are underwater, worth less now than when you bought them. Taxes due on gains from other investments can be offset if you sell an investment at a loss. You can do so in the future if you don't have any gains to offset this year. Review the fundamentals of tax loss harvesting, such as whether you owned the cryptocurrency for more than a year. So are you ready to become rich in 2023? Share your feedback with us in the comments. And subscribe to our channel for more updates.